Hello, everyone. Welcome to Charting the Second Half. I'm Dave Keller here at StockCharts.com, and I'm super excited to be able to virtually sit down with a good friend, mentor, and a name and a face and experience that will be familiar to most, if not all of you, Ralph Acampora. Ralph is one of the founding members of the Market Technicians Association, now the CMT Association. Ralph mentored me and essentially all of Wall Street, essentially taught them how to use technical analysis and how to analyze things. You know, it's funny, in my office, as we were getting Ralph set up with the video and everything, I realized a couple things in my office literally make me think of Ralph Acampora. Number one, I'm actually sipping coffee right now from my MTA mug that I got when I was president of the organization 10 or so years ago. I also noticed when I was plugging in my phone that I have a picture, Ralph, of you and I on the floor of the New York Stock Exchange when we were there for an MTA event years ago, and it's one of my favorite pictures. And then the third thing that makes me think of you is just a chart, because I feel like when I'm bringing up charts, which I do all the time, in some way I'm channeling Ralph Acampora with what you've taught me about not taking things too seriously, but trusting price, trusting the trends. So Ralph, welcome, and thank you so much for giving us some time today.
Thank you very much for the introduction. And I'm sorry I remind you of it. I'm sorry there's so many things around you that remind me of me.
I can't get away from you, unfortunately, in my office. So overall, it's a very
I got to get a pair of dark glasses for you. Okay.
Now, so you know, we're
a lot to talk about today.
There's so much, and we're at an unprecedented, I feel like, period in market history, and where you know there's so much uncertainty. There's so many opposing forces going on here, and what better time to really focus on the charts and dig into the message of technical analysis. We're starting with the S&P 500. Can you just orient us all with where are you at when you're looking at this chart of the S&P, essentially round tripping from February to March, and now nearing the February highs again? What are you seeing when you look at this chart here?
Well, first of all, if I may, I'd like to go back to the decline itself in February and March. Just look at, just staring at that picture scares me. I mean, it's a straight line, virtually a straight line down.
Yeah.
And there's an old friend of ours, yours and mine, and I have to give him a shout out, Craig Johnson at Piper Sandler.
Yeah.
Came out on March, the next day, the low was on March 23rd. The next day, he was on CNBC with Brian Sullivan, pounding the table saying, "We've seen the low." I got to tell you, when I heard that, I called him. I said, "Are you sure you wanted to do that?" And I, looking back, I mean, the guy was, and he listed all of the reasons, technical reasons, how many stocks are below the 200-day moving average, et cetera, et cetera. Yeah. And more important than that, he, of course, was the sentiment indicator. Everybody was so bare, and rightly so. I mean, it was real scary times. And everybody's arguing, well, there's going to be a U bottom, a V bottom, a double bottom. Well, literally, from a technical point of view, and you're talking to the old teacher, that is an extended V bottom. Look at the coming off the March 23rd low. We had a few days up, and then we backed off in early April. So 3 or 4 trading days in April. That, by definition, is an extended V. That's when I started getting really, really optimistic, right, because there was no, that was the test of the low that I was looking for. Yeah. And that was very, very important. And then, of course, right soon thereafter, you had your gap and then the breakout. And boy, I was out. Now I was pounding the table. Took me a little time, but I was there. And I think if you look at the most recent activity, up on the right side there, and you can see that the Dow, in this case, the S&P 500 and the Dow, of course, we had a picture of the Dow, look exactly the same. And they've been trapped in a trading range for the last, better part of the June, early July, period. And I would like to compare that with the NASDAQ Composite. If you can pull that up for me, I'd appreciate it, because you're going to start seeing the differences. And this is what I'd like to talk about, the near term versus where we should be going a little bit longer, looking out into the second half of this year. So that trading range is very important. By the way, in that S&P 500, that the low of that period there, let me get my numbers, 29 2,965.66. I'll repeat, 2,965.66 is the short near-term low in the S&P 500. And that's the intraday low. That's critical support. Keep that in your mind, because as long as we stay above here, and you in your opening comments, Dave, you're talking about how a confluence of all this craziness going around, and I'll list a few of them later, and it's crazy. I mean, I get up in the morning, and having my coffee and looking at it, oh my God, look, this is terrible. And then 10 minutes later, the market's up a little bit. I'm going, I don't believe this. And so we're going to have to live with that. I mean, a lot of cross currents, but we as technicians have levels and trends that we respect. And if you don't, then you're not a technician. And I respect that circle where you have right there in the S&P 500. As long as we stay above that, I'll mumble, and because I'm still basically very, very optimistic, but I watch for the areas that show deterioration and concern. As long as we stay above your circle there, I'm okay.
I love that. I've always loved the simplicity of how you approach things, and I think you've hit on a key point, which is the uncertainty that I mentioned in many ways is sort of irrelevant. It's like, as long as we remain above that swing low from the second week in June, that 29.60, 65 level. The trend is still positive, right? We're still making, we're not losing ground, and so uncertainty aside, it's like, just focus on the price, focus on the level, and make sure we remain above it, right?
I like to tell people there's only one thing you own. You own price. I don't own the RSI. I don't own the MACD and the stochastic and all this other fancy stuff, which is very, very nice. I don't. I own that. I own the price.
Now, what you mentioned,
got to respect trend.
You
always.
Mentioned the NASDAQ Composite. Obviously, there's this situation we have now where it's sort of mega cap tech, consumer, communication services stocks, and then everything else, and they've just left everything in the dust. Does this concern you that the NASDAQ continues to just blow to new highs while the S&P does not, or does this make you feel fine that things are holding in just okay?
Well, you jumped ahead of my presentation, but I'll let you slide on that. And I just wanted to say, look at the difference in pictures. This thing's at an all-time new high. I mean, we're talking about respecting trends. That's fantastic. When I see a chart up like this, I get a little nervous. I get a nosebleed because we're defying the laws of gravity a little bit. So on a short-term basis, sure, pull back and consolidation and technology, I think, is really needed. Longer term, no, I'm not going to fight that trend. That looks pretty good to me. But you bring up a very, very important point. And this is a phrase I love to use, and I'm going to quote: rotation is the lifeline of every bull market. Now, we can have the leadership going in that uptrend, which you see right there, but I need to see those stocks and those indices that are in those neutral trends break to the upside. That's the rotation I have to see in the coming weeks and months. And if I don't, then I'll really get nervous with just technology leadership. I can live with it right now, but I need the rotation. And that's what I want to show everybody. What's on the verge of rotating and what's hopefully going to follow through and complement the strength in technology. But we still have to see that yet.
It's a great point. And so, tech has been leadership. And I think you can see that just the relative performance of the NASDAQ, of the Qs, just the XLK, they're all just sort of gone vertical. So your point is that's okay for now. I mean, the trend is up, and you've taught me, don't be afraid of an uptrend. That's actually a good thing. That's what we want. But at some point, I hear what you're saying, rotation. So then the question I'd want to pose immediately then is like, where would you be looking? Where are places where you'd be thinking rotation would potentially come from? Where should we be looking for that?
Okay, that's the next question. Let's look at the S&P Mid Cap Index.
Sure.
Mid caps. There's that neutral trend again. See on the right side?
Yeah. Yep.
See, you know what the support level on that is? 1,700, exactly, right there. You got it, 1,700.
Yep.
And as long as you stay above 1,700, fine. It looks a little weak to me. Look at the RSI, hasn't hardly recovered at all. It's very neutral. I'll stay neutral. You're still above your moving average, your 50-day moving average, which is fine. Okay, we stay above 1700. I'll give it the benefit of the doubt that this is where we'll see the rotation. Actually, if you go back just a little bit in late May, early June, you started to see that rally right up in there. See,
Yeah.
right into June. And that rally was selling. I got really excited then because that's the rotation I was looking for.
Yeah.
Unfortunately, it didn't last long.
No.
So I'm a little, kind of hovering in the corner saying, okay, I can live with a pullback. As long as we stay above our 1700 support level, I'm okay with that. But in the weeks ahead, days and weeks ahead, I've got to see the mid cap index break to the upside, and that would really, really be encouraging. I could say that for the small cap stocks, same picture, same situation. There you go. That's the S&P small cap.
Mm-hmm.
Yep, that's and you'll see the support level there, and the trend is exactly the same.
Yeah.
I'm willing to give it the benefit of the doubt that we hold.
Right.
If you take up the XLE, that's the energy sector,
Sure.
and you can see that yesterday we had a little bit of a problem. The XLE, which is energy, um, actually started to break down a little bit from that neutral phase there. I don't know, is that the XLE?
There we go.
There it is. Yeah, there it is. See, it was going sideways. It had leadership in late May, early June. It was breaking out and then pulled back, just like I mentioned. And then yesterday and even today, I guess we're just even on the day as we speaking. But I don't want to see much slower than that because you're getting deterioration. So that's an area, a sector right now. I'd be a little hesitant by adding to it just right now. I'd like to see more stabilization before I do that.
It's really interesting. I want to get back to some sectors. If we could we just wrap up with small caps and mid caps? Because
Sure.
as I'm looking at this chart, the thing I would want to add is just the relative performance. Because if you look at small caps versus the S&P or mid caps versus the S&P, we've had this situation where essentially the mega cap trade has been dominating, right, with the mega cap tech stock. So here's the relative strength of small versus large, and you can see it's just it's rolled over, especially in the last couple of weeks, and this week it's making a new relative low for the last 6 weeks or so. So so with mid caps and small caps, they both, I think, noticeably broke right above the 200-day moving average before coming right back down. So your point is, as long as those kind of hold these key support levels, that's okay. If they would start to break down, that would be a bit of a concern, right?
Yes, it would. Yes, that would start to concern me. Not that I think we'll go back to the March lows necessarily, but you lose that momentum. And then in a minute or two, we're going to be talking about as we go closer towards the election and, what's happening with the, was it yesterday, I believe, that the EU, European Union, downgraded their growth forecast. And, so you're starting to see doubt out there about the virus and its impact on the economy. So those are factors that maybe is causing this market to hover where it is right now. But if it gets appreciably worse, and God only knows what's going to happen with this virus, you could see that break down. But I hold out until that happens.
So with energy, you mentioned that's one area that's just arguably potentially starting to break down here.
Yes,
and you want to see things like this hold. I guess another sector that comes to mind that's been beaten down that hasn't really participated. Next are financials, right?
Good. I'm glad you bring that up. That would be the next one.
But
unlike the energy,
what are you seeing when you're looking at this?
Unlike the energy, it hasn't broken down in price.
Yeah,
still holding above its recent low. And yes, look at your relative on the bottom. Of course, it's just actually made a new low in relative. I didn't know that.
Yeah.
Relative to the S&P. Yeah, very disappointing because in late May it was starting to break out and you could hear me cheering in the background saying, hey, rotation into into financial is very, very important.
Yeah.
But again, I'm willing to leave the door open that this is a pullback and a consolidation. Okay, that's cool. But I got to see evidence, and I just don't see it yet.
So at some point, I guess when you still, and if we could switch and go to technology, right? Just you have
Sure.
those two charts in your mind, and then you look at the XLK and you see
Yeah.
how
There's
different the experience has been
Yeah.
with these different sectors.
Exactly right. Look at
So
that.
I would
Look at that
assume this is
versus the
similar to
S&P.
this is similar to the chart of the NASDAQ Composite, right? For
Absolutely.
obvious
Yep.
reasons, but
Yep. Yep.
so I would assume this trend is in place. That's good, but again, if it's the only sector that's really doing this,
Yes.
it's a bit of
And
a
it's like what, 5 stocks,
make up.
percentage-wise,
Yeah, that's right.
dictating the whole thing. Come on, I've lived through periods like that before in the late 90s.
Mm,
And in the early 1970s, I didn't say 1870s, I said 1970s. It was the Nifty 50, and you don't remember that, but there was a handful of, in those days, there were technology stocks, but like IBM and a thing called Control Data, and once, yeah, and you had to see in the old days the advanced decline line. In fact, it was Johnny Brooks, as you know, was one of the co-founders of the Market Technicians Association,
sure.
CMT Association today. Johnny and I used to argue with our bosses, well, why are we keeping a chart of the advanced decline line that's been going down since 1955? And it was just terrible. And what it was a long extended view, multi-years of underperformance of the secondary stocks, and it was the Nifty 50. So
Mm,
I've seen this, but that can go on for a while. So I'm not throwing in the towel yet, but I've seen this before where it could, but it doesn't have a pretty ending. Um, so you just put a good trend line under that NASDAQ or the XLF
yeah.
and respect that trend line for sure.
Right, right,
Broken, and
right.
I think you got to do it. Right.
Are there other
From the
sectors
March
out there
25th low, 23rd low, you put your uptrend in there.
right from there?
Yeah, absolutely.
Are there any other sectors you want to look at? Maybe like a consumer or something like that?
Oh yeah, yeah. I got a bunch of them. How's about we take a look at the XLB
Materials.
materials?
Okay.
Yes, this is you know unlike the neutral trends that we like the energy and the financials that we're looking at. This one looks a little higher. It's neutral short term, but it's got an upward bias, and you can see the relative is turning up. And I think this has this is, if I had to pick another group that I think would make new highs, I would go with this one.
With
And
materials.
of course, you got gold in there and copper, and they look very, very good.
Right. And gold
Yes,
stocks have done very well. I mean,
absolutely.
gold
I'm
spot
very bullish on gold
making
and
new
have
highs.
been for a long time. Maybe
How
you
do
want to
you
take a look at a picture.
reconcile, if I could divert just a second, how do you
Sure.
reconcile gold making new highs and technology making new highs? They feel
Well,
in some way like those would be opposite, I guess,
yeah.
right?
Well, yes. Again, you're jumping ahead of me because in my finale, I was going to talk about the divergence
We can
and
save it. We'll save it.
the canary in the coal mine is gold. Okay.
Yeah. Okay.
Yeah.
So
Okay.
materials, totally fair, and I think you're right.
Yeah.
It's nearing previous highs where,
Yeah.
and
Yeah.
especially compared to like financials and others, nowhere near.
Yes. Yes. So
Okay.
those are the two prettiest pictures I have for you: the technology and this one, XLB. And after that, either they're neutral short term or very neutral long term. Look at utilities.
Mm,
I mean, that's been going sideways for months. At least the financials had an upward bias there for a while. Look at
yeah,
utilities, basically flat since the latter part of April or early April.
right.
And so well, let me see. We have utilities look like that. Healthcare looks like this also, believe it or not. Let's take a look at healthcare, HLV. Look at
Here we
that.
go. Mhm.
Look at that. Flat. And I'm talking about price. It made a
Yeah.
new high and then backed off, and then just hopefully we hold above support levels. And and uh, and if it does that, then we'll avoid a problem. The support level on that is 95.42.
Right.
right down in there, right there.
It's interesting. I mean, healthcare stocks rally. I mean, they
Yes.
ripped out of the lows and really
Yep.
outperformed during this period. And then
Yep.
from then on, it's been sort of it's
Flat.
been
Yeah.
flat,
Look
and
at the
now the
relative on
banks
that. It's
have gotten
just,
killed.
yeah. Yeah. And most of the markets like that. In fact, when I look at my sectors, I got 60% of them look like that. Okay.
Yeah.
So if you said, put a gun to my head, what do you think of the market internally? I say, well, it's neutral.
Right.
And I'm willing to give the benefit of the doubt that it holds above its support levels, which in most cases, except for the energy, we're doing so. So,
Yeah.
and I don't lose sleep with just technology leadership, but I keep a close eye on it because that can't maintain itself for very, very long unless we get the rotation I was talking about.
Got it.
Make sense?
Yeah, absolutely. What other sectors should we look at?
Let's take a look at XLY.
Sure.
Discretionary.
There we go.
Is that a double tap?
You can make the argument for it, right?
Yes. It's because the RSI's never quite get up there.
No.
The relatives looks pretty good still.
It's not bad. I mean, the challenge
Yeah.
with consumer discretionary, Amazon is such a huge weighting in it, right? It's 25% of the XLY, I would say.
Is it really? Yeah, I didn't know that.
Huge.
Yeah. All right. But it's still above support level, so I'm not complaining. But if I had, you asked me if I had another picture that concerned me, and I said that would be my other one. That's other than that, most of them are neutral.
Got it. So it's a potential double top in the XLY, and if this is basically that second.
I need a breakout.
Yeah.
I need a breakout in that. And if I get the breakout in the XLB, that would be good also. Hey, can we just change the subject a little bit and look at other things that are breaking out?
Absolutely.
Let's FXI.
Okay.
FXI. China.
Yeah.
China. Look at this thing. Boom. It's the last couple of days.
Yeah.
Look at the gap it left.
Yeah.
Yeah. It was going neutral. We had sideways and then broke out. And the ECNS. That's China's small cap. Look at that. Wow. Yeah.
It's a decent breakout.
If you look at this on a weekly basis, you're going to see a major trend. It looks like to me is broken. Oh yeah, sure. From the high back in, was that March? Whatever it was. Yeah.
So did this trend down from the high?
Yeah, exactly. Yeah, and the FXI. Now, which makes me look at, let's take a look at emerging markets, EEM.
Sure.
Yeah. Now, look at, I've been, and everybody talks about the U.S. markets. I think you got to look out over your shoulder, and maybe there are other places to invest, at least near term anyway.
I feel like international stocks in general, people, especially US-based investors, have just sort of been ignoring them because the dollar had been strong. US stocks have been outperforming, but all of that appears to have been changing in the last couple months for sure. Now you're having a weaker dollar, and now charts like this, EM is starting to, the relative strength on EM is really
very impressive.
Really impressive over the last 4 or 5 weeks.
Yep.
Okay.
I like to look at, let's take a look at Germany, EWG.
Sure.
Just to look over our shoulders. Looks like some of those sectors we were looking at, short-term neutral and consolidating as long as it stays above its support level made a few weeks ago. Maybe that's the next area to break to the upside. Bottom line, what I'm trying to say is that a lot of what we look at, majority of what we look at is flat, short-term.
Yeah.
And in the weeks ahead, we know what we want to see. We want to see it rotate into those areas. And I tell you, you're going to put another leg up on this bull market. It would be phenomenal.
Yeah.
And that's what I'm hoping will happen. Okay. And of course, I have my eye on those support levels very carefully. That's the message I want to leave with everybody today.
I love that. We
Yeah.
only have a couple more minutes, Ralph. What other charts should we look at?
We didn't take a good look at gold. Let's take a look at gold.
Sure.
I'd like to look at it on a long-term basis first, monthly basis. You know, people forget where, you know, they look at it, well, you know, it's consolidating. Heck, man, that's got a huge, look at that base. I think it started in 2013. Yeah, something like that. Yeah, somewhere in there. And you're talking like 5 years of just consolidation, and boy, oh boy. And we're poised to make all-time new highs. I mean, it's just, and it's not, and you know what? It's also an indication that somewhere down the road, and I'm not an economist, it's going to be a year or 2 or 3 from now, we're going to have to, the economy is going to get a bump because of all the Fed money that's being spent to support us in the COVID-19 situation here. I think we may get a little inflation and problems with interest rates or something. And that'll be just a haven for gold. So that long-term picture in gold says much higher over time.
Pretty
and if you can look at it short-term, you'll see that comparing it to all the charts we've been looking at, that looks like NASDAQ.
Yeah, right.
Yeah, doesn't look like utilities or anything. And you got the daily chart here, I see, and that's just a recent breakout. Look, for several months it was neutral.
Yeah.
You know, look at that, April, May, June, now we're breaking out. So, you know, people say to me, oh, gold's extended. Not really. Not when you see that daily chart. It says, no, it consolidated, very nice, very orderly. And now you're having an orderly breakout. You hear people on television talk about it a little bit, but I don't hear a lot of people pounding the table. I really like gold and have for quite some time.
Yeah.
Yeah.
It is interesting how you compare this to what you think about with technology and some of the tech names that feel super extended. This, as you point out, doesn't feel very extended. It feels like just recently broken out of a base.
Thank you very much. Exactly right. Exactly right.
All right. We've got about a minute left, Ralph. Is there anything else finally that we should look at together?
I don't know. How's about the advanced decline line? I'd like to see that. I haven't seen that in a while.
Yeah, I'm going to show you this.
Yeah, let's see the AD line on the New York Stock Exchange.
So this right here, this red line, and sorry about the color, but the red line is the NYSE advanced decline line.
Oh, there it is. Yeah, well, you know, I haven't seen it in a while, and you can see it's just like the other charts I showed you. Short-term neutral, had a nice little upkick in late May, but never followed through. That was the rotation I was starting to see, and then it died. Now, as long as breadth consolidates a little bit here, we need to see a new high, a new recovery high, and the AD line. I tell you that's a real indication that this market is broadening out, and the tide is lifting all the boats. And until it does that, it's just going to be a very segmented market.
Ralph, this is a perfect place to end. 30 minutes with you goes by so quickly. This is fascinating, though, and this is a great chart to finish on because I think it summarizes a lot of what you talked about. Certain places relatively extended, things like tech and some of those leadership spaces. Breakouts on the advanced decline line would suggest that overall that things are starting to agree and starting to break out along with tech.
You get the next leg up in the bull market. Yes.
Ralph, thank you so much for all you have done and all you continue to do to mentor me and other analysts, other strategists, other investors, and thanks so much for sharing your take with us today.
Thank you very much and for having me on. And tell Gretchen I said hello.
We'll do.
Okay. All right.
Ralph Acampora joining us on Charting the Second Half.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.